9th December, Friday, MEO with Cal, right? The market is waiting for the CTA personnel. What does it mean? Now, apparently people have been asking why is the stock market relentlessly, trying to recover? Because there's something that probably a lot of people are missing out is that the CTAs, yes, who are they? I'll tell you more in detail. They are not selling yet. So as long as they're not selling, the market will still stay strong, okay? So I'll tell you more in detail. Let's look into this video, all right? But once again, disclaimer apply as usual. Please make sure you do your risk assessment, and thank you, AIMS, for the kind sponsorship. Now, the stock market last night rebounded 182 points for the Dow Jones, S&P up 500 up by 29 points, and the Nasdaq up by 123 points. So, is this the bottom of the cycle? Well, I don't think so. In fact, after 5 days of downside, it's kind of quite predictable that we know that the market will recover, at least on a technical ground, and it really happened. Now, let me dive into why I don't think so, because I still believe what I'm seeing right now. The 10-year yield versus 3-month yield, the spread itself has gone to the new low once again. Oh my God, look at it. Look at the current level right now, right? Let's take a look. The current level now is right here, the spread, and it's way lower than what happened during the Lehman Brothers time. Sorry, within the pandemic time, and also lower than the Lehman Brothers time. So all these information tells you that very soon we're going to see the recession word coming in, all right? And of course, there's more detail to share with you. Let's take a look right now. This is all the way since 1961, all the way for the last 60 years. Take a look, guys. This is the inverted spread, okay? Inverted, yeah? Now you can see on our screen right now that every time when the number goes to a certain figure, you can see the recession usually comes, right? You can see that almost every time, right? Okay, let me just show you something very incredible. Let's take a look here. If you put at the 0.3 or the 30% mark itself, you will notice that almost every time that once you hit this 30%, recession is always at this card, okay? You can see it right now. Very, very incredible. The only time it didn't happen was back in 1967 when you went through it and didn't really happen. But of course, the recession came in about 2 years later. So of course now we are now more than 30, hence therefore it's 38.05%. What do you think? These are statistics for the last 60 years. You cannot deny this. As I've been telling people this, you just have to believe and prepare. So of course we have the continuing jobless claims has started to go up, and this is one of the signs of recession, because when you have people basically asking for jobless claims, meaning that they're telling you that they are already losing their job, and you can see the numbers now is now at the highest level, okay, since early February. All right, so that means that we're talking about from the start of the year, the market, the jobless claim has came down quite a fair bit, right? Then after that, in June, it went sideways, and then by September, it started to go up. All right, so that was where we know that the Federal Reserve have been increasing interest rate, and that hits the company. And of course, is this a good sign? Well, at least Federal Reserve really wants people to get jobless, because that will lower down inflation. But of course, it really highly depends on how it works, because it's a very delicate balance. If the jobless claim keep on surging, the economy couldn't hold back, and things get very bad. Of course, earnings will be affected. Hence, therefore, you will have your recession. Okay, and of course, company stocks value will go down because of the PE value. So all these are going to be a very delicate balance, and you just have to be very careful of what you wish for. So you can see right now, right, the tech companies are really releasing many people. In fact, in the month of November, they released the most, about 50,000 people, all right, from different companies like even Twitter, Meta, Amazon. You can see that. Yep. Okay. The thing is this. If that's the case, then why people are not selling it? Well, because there's some data like this, like the manufacturing ISM PMI. You can see that it's like, the numbers are going down, but the cyclical to defensive ratio is still kind of positive. So that means that there are people who still kind of believe that what is the market still okay, the economy is fine, and there's no need to panic. Okay, and this is one of the reasons why the stock market is still holding on. So let's just understand who are these CTA. Okay, CTA stands for a commodity trading advisor. It's an individual or an organization for compensation or profit, advises others directly or indirectly as to the value of the advisability of trading futures contract. Okay, seriously, these guys are the one that tell people what to do. And of course, in history, you can see that whenever they are selling, the S&P 500 will come off, right? And if they are buying, the S&P 500 will go up. So it's like they are like the advisory, and they actually take a very open and important position. But the problem is that now these CTAs are not reacting. You can see that The S&P 500 has dropped quite a fair bit, right? At least by 20% from the highest point. But the CTA, right, they are still thinking that the market is still kind of okay. So that is the big problem. Okay, so now what we have is a very huge spread right now. So of course, if the CTA start to really dump or start to go negative, then of course the S&P 500 will really go down quite a fair bit. On the converse note, if let's say the S&P 500 is overdone and the CTA retain their what you call bullishness, who knows, the S&P may recover, but I can tell you this is not very possible. So why is that so? Because something big is actually happening around here. Now, you must understand that this Janet Yellen just said recently, she says that a recession is not inevitable. So in short, trying to tell you that recession may not be there, all right? But the BlackRock guy, okay, came in and said, Larry Fink came in and said that no, recession is on its card, all right? So the question is this, can we trust Janet Yellen or should we trust Larry Fink? But of course, again, BlackRock recently has some issue with their own company, so it's like, okay. But you must understand, Janet Yellen he came on the media and she actually said that she was wrong on the inflation. So if you think back itself, right, what do you think? All right, let me just show it to you in PowerPoint just in case you get misunderstanding here. The PowerPoint didn't really come out well. Let me just tweak it in. Let me just correct this. Here we go. All right, you can see that this is from the BlackRock CEO said that get ready for recession. Okay, so that is why we have the earlier picture of that. So just to make sure that we're all on the same page. Yeah? Okay, got it? All right, so can we trust Larry Fink for what he says, or can we trust Yellen, who was wrong previously on inflation? So let's just see what happened next. But the boys are moving in right now. Apparently, the hedge fund have been selling non-stop. All right, this is something incredible. This is showing that the prime book of the U.S. financial, and of course, that the PB, the prime book data highlights show that the hedge fund are selling the financial for the 5th straight session, driven by the short sales of outpacing long by 9:1. So in short, right, this is one of the heaviest selling by the prime brokers. All right, so this is something not a very good sign. Now, of course, we have seen that before in January. Can you see this? In January, there was heavy selling, and of course, after that, we know the stock market pulls back quite dramatically. All right, sorry, this should be here. That was back in 2022. And also we saw that in 2021. So all this is not even near, because now where we are right now is actually much lower. Oh gosh. So what do you think? Do you think that the market is going to crash? I don't know. All right. So the thing is that the courtesy of Goldman Prime brokerage desk, yeah, it shows that the current now, the net book is really selling off. All right. We have seen a few times this before, and of course we know that the particular month the market came off quite a fair bit. So all these data you don't find in mainstream media, and I'm sharing with you right now. I'm telling you this, something is just not right. Be very careful, especially next week. All right, to me, next week will be the main driver. All right. So one of the reasons is that about this is called the mortgage-backed securities. Now, what is this all about? Just in case I refresh your memory. Now, basically, right, you can see from here it's our mortgage-backed securities, like a bank lending John money, and John buy the house, okay? So what the bank does is bundle this into a pool of mortgages, and then the large bank buys the pool of mortgages, and the large bank actually resell it to the investors, okay? So you got my point. So what's the big deal about this? Well, if you remember, this was the thing that brought Lehman Brothers down, okay? One of the thing, okay? So what's happening? Well, because this is happening. Do you know that Federal Reserve is holding as much as $2.6 trillion worth of mortgage-backed securities? Because they bought a lot during the Lehman Brothers time and along the way, and they are now the biggest holder, right? So if the thing is that if they are the biggest holder, what's the problem then? Well, the problem is this, guys. The problem is that now the mortgage bonds are very cheap, but no one is buying. That is the problem. For the first time really this century, there's no government buyer of the last resort. This is really bad. It's coming from Bank of America team. Yeah, no, I say that. So you can see right now, right, this is the cheap but likely to go cheaper. Apparently, right, this 8.7 trillion market for mortgage bond with the government backing itself is really there, but no one is ready to buy. And of course, if this continue, that means that people are getting worried. And if people are getting worried, then what will happen next? Then there will be some liquidity crunch, okay? We all know that this the Federal Reserve is not going to buy more. In fact, they're letting it to be mature and just let it drop off. So if this is going to keep on doing, there will be a problem, guys. That will lead to another bigger problem coming up. And of course, if you can remember what happened to Lehman Brothers, things got very nasty after that. So just to wrap it up, right, guys, some people have been asking me, Kel, why can't we have a Fed pivoting and things get back to normal again? I'm so sorry, my friends. When you increase interest rate over a certain period of time, right, you actually send the right information to the market because that means that the economy is doing fine. But of course, to a certain point, when the interest rate gets a little bit too taxing to the people start to go sideways because the market knows that this is near a peak. But very incredibly, when the Federal Reserve really started to pivot because of something happened or some companies got hit or something, the country got issue, you notice that as the Federal Reserve pivot, meaning they change direction, right, the stock market usually will come off heavily. So you look back again, right? Okay, this is what happened again in 03 to 07, whereby the US interest rate goes up. You notice that the stock market also generally go up. Why? Because the financial stocks actually benefited from there. And because of that happening as well, right, the banks are much more comfortable to lend people the money. So they make more money while they make money from interest. And of course, the economy is strong because of the extra money in the pocket. So everybody works, okay? But the moment that they feel something is very wrong, when the Federal Reserve feel that, okay, something is not good, they start to so-called pivot or sideways. That is where the stock market will also go sideways. And very incredibly, when the Federal Reserve decided to pivot it, meaning they take the opposite direction or cool down the market, you notice that the stock market goes into recession, and definitely the stock price will come off. So you can see this all the way from the last since 1976 until now. It has never failed to repeat itself, all right? So all these are things that you must understand what we are facing. But of course, again, as long as the CTAs are not dumping or calling for sell, the market is still going to be pretty strong, all right? So let us hope that things will be fine, but let's be careful, all right? By the way, I have left the special quote on one of the PowerPoint slide. Look out for it, put the name, or the quote name in the quote itself into the comment box, okay? Let's look at the chart for today, shall we? Alright, so for the US market, right, we have a recovery yesterday. Well, based on my chart, it's now below my 92.5%. So as long as it stays below 34,181, I can't see any reason to be buying. In fact, I still think that the Dow will come back down to 33,258. Alright, that's about 600 points. Now, yesterday I thought the market will come off, but instead the market chose to go up. Fair enough. So this is pretty normal, but we just wait for it to come down to this point here. Now, there's a thing note here. The last time when this happened, when the price went up and it comes back down to 33,258, you notice that that was where the market stopped, right? And after that, it rebounded strongly. So my view is this: unless the market closed below 33,258, if not, any seller should sell, take a profit here, and let's take a look, okay, and see whether what's happening next. All right, this is very critical and important. Now, China's share basically yesterday rebounded and closed above the MA200 for the second time in a row, and this is actually a very good sign. This could actually send the China A50 to a higher ground, to 13,000 itself, all right? So 13,400 is the next level. Let us see whether can it stay there. All right, and just a quick one on the S&P 500 before we wrap it up, okay? So the S&P 500, you can see that it really stops at the 85% beautifully. That's why I say that this is a very powerful indication, a mathematic here. And of course, now the target next of our S&P 500 will be back to 38.55. Okay, so traders, watch out for this. And of course, for the NASDAQ, let's go a quick one on NASDAQ. Where are you, NASDAQ? Okay, here we go. NASDAQ is still, if you didn't notice that, NASDAQ is still below the 80% mark, which means that the NASDAQ is still in a bear territorial, okay? And of course, this is likely going to bring down lower. In my opinion, it's all right. The next wave, if there's going to be one, it should bring the NASDAQ all the way down to 10,300 area. That should be the next target, because you can see that the market has tried to recover, but the last time when the market was doing this, you can take a look here right now. The market from this point here went up, right? It went up by 2,600 points. And it took 43 trading days, right? 43 trading days. But if you look at it this time around, right, from where we are to here, we are at a 43 trading days, but we're only 1,200 points. You got my point now? So which means that for the same time duration, the stock market for the NASDAQ itself, right, did not really go as much as the one here. Hence, therefore, in my opinion, once the market loses strength, the selling will not be small. All right, so that is my view for today. A short one. It's the weekend. I wish you all the best, and remember, we have the spin the wheel lunch with Cal tomorrow. All right, I'll see you guys again. This is Cal signing off. Have a great day. Bye bye.